Today, I want to give you a status update on the US debt crisis. And I know there's a lot competing for your attention right now. The war, the markets, the headlines that keep coming. But here's the thing. While everyone has been focused on all of that, the debt situation has gotten worse, quietly, steadily, and faster than most people realize. The U.S. national debt stands today at $38.86 trillion. That number comes directly from the U.S. Treasury's own data, updated as of March 4th. And here's what should stop you in your tracks. At the current pace of growth, we are going to cross $39 trillion in approximately 2 weeks, by around March 25th. 2 weeks, okay? So yes, we need to talk about this. Because what's happening in the debt market right now is not some abstract government accounting problem that lives in a spreadsheet. It is a direct threat to your purchasing power, the cost of every dollar you borrow, and the retirement security of tens of millions of Americans. And I want to walk you through the full picture today. How we got here, the deficit, the interest payments, Social Security, and what is happening in the bond market right now that should concern every single person watching this video. Let's get into it. So let's start with the fundamentals, because honestly, the core of this problem is not complicated at all. It sounds complicated when economists talk about it, but at its heart, it is very simple. Every year, the federal government spends significantly more than it collects. The gap is borrowed, and it compounds. The government issues treasury bonds, treasury notes, treasury bills. It borrows from investors, from pension funds, from foreign governments, from the Federal Reserve itself, and that borrowed amount is added to the total national debt. And it never gets paid down. It just accumulates year after year, decade after decade. Now, you might ask, okay, but why can't the government just cut spending? And the honest answer is because the spending commitments that drive the debt, things like Social Security, Medicare, military, and now increasingly interest payments, are politically almost impossible to touch. And we'll come back to that. The second piece of this, and this is crucial, is what happens when the debt gets so large that the government struggles to keep up with the interest. The answer historically is that the Federal Reserve steps in and creates money. It prints money to monetize the debt. And printing money is inflationary. It doesn't show up all at once. It seeps through the system over months and years. And what it does, quietly and consistently, is erode the purchasing power of every dollar you own. Your savings buy a little less each year. The cost of living creeps up. The wealth gap widens because people who own hard assets, real estate, stocks, gold, get protected, while people who hold cash or live paycheck to paycheck feel the squeeze. This is not a conspiracy theory. This is the mechanism. It's how fiat currency systems work, and it's been playing out in plain sight for decades. Now look at how fast the mountain is growing. The total national debt was roughly $28 trillion at the start of 2021. 5 years later, it is $38.86 trillion. That is nearly $11 trillion added in 5 years. The debt is currently growing at approximately $7.23 billion per day, every single day. That is $301 million per hour. In the 10 or 11 minutes it takes you to watch this video, the national debt will have grown by roughly 50 million. And here's the personal number I want you to keep in mind. Every American's share of this debt right now is $113,638 per person. For the average household, well, that number is $288,283, and it goes up every single day. That is not an abstract government problem. That is a liability with your name on it. Okay, now let's look at what is actually happening in fiscal year 2026. And just to make sure we're on the same page, the government's fiscal year does not match the calendar year. Fiscal year 2026 started in October 2025 and runs through September 2026. So we're already several months into this fiscal year. Here's where we stand right now. The federal government has collected $1.78 trillion in revenue so far this fiscal year, and it has spent $2,148 trillion. That means the government has already spent $700 billion more than it has brought in, and we are not even at the halfway point of the fiscal year. The Congressional Budget Office is projecting that the total federal deficit for all of fiscal year 2026 will come in at $1.9 trillion, and total federal spending this year is projected to reach $7.4 trillion. Let's put that in context. Federal revenues this year are expected to be roughly $5.6 trillion. That means the government is planning to spend $1.9 trillion more than it earns, and it will borrow every dollar of that difference by issuing new debt. To put that in human terms, the U.S. government is spending at a rate of $7.4 trillion a year, collecting $5.6 trillion, and the gap is bigger than the entire GDP of every country in the world, except China and the U.S. itself. Now, I want to address something that comes up every election cycle, because it is important, and the nuance usually gets lost. It does not matter which party is in the White House. If you pull up a chart of annual federal deficits going back 20 years, and I mean actually look at the data, not the talking points, what you see is a consistent bipartisan pattern. Each administration tends to overspend more than the previous one. Obama spent more than Bush. Trump's first term spent more than Obama. Biden spent more than Trump's first term. And the current trajectory under this administration is heading in the same direction. This is not a partisan attack on anyone. It is an observation about a structural problem that no administration has been willing to genuinely fix. Because fixing it would require telling people uncomfortable truths and making politically painful decisions. And that is not how Washington works. And look, you will hear people point to the deficit numbers from 2024 to 2025 and say the deficit went down. Went from $1.83 trillion under the last administration to $1.78 trillion. And on paper, fine. That is technically accurate. But let me tell you what those numbers are not telling you. In 2025, the federal government collected a substantial amount of revenue from tariffs. The Supreme Court subsequently ruled that a significant portion of those tariffs were illegal, and the government is now in the process of refunding an estimated $166 billion to $182 billion to approximately 2,200 companies that were charged those tariffs. The administration actually went to court and argued they should be given years to spread those refunds out, presumably to keep the fiscal year 2025 numbers looking cleaner than they actually were, and to push the problem into the next administration's lap. The court said no, refunds happen within days, not years. So when you back out that tariff revenue, money the government was never legally entitled to keep, the real deficit for fiscal year 2025 was worse than 2024, noticeably worse. The improvement in the headline number was built on revenue that had to be returned. And now you have those refunds going out the door, adding to the fiscal pressure of 2026. This is the pattern. It does not change based on who is in office, and the hole keeps getting deeper. Okay, now let's talk about something that does not get enough attention in the public conversation, because most people focus entirely on the total debt number and miss what is happening with the interest payments underneath it. And the interest payments are, in some ways, the most alarming part of this whole story. When you owe $38.86 trillion, you have to pay interest on that debt every single year. And that interest bill is not flat. It is not declining. It is climbing steadily and relentlessly. And the CBO's projections going out to 2036 look like a hockey stick. Here's where we are right now. The average interest rate on the government's total marketable debt as of February 2026 is 3.35%. That might not sound dramatic, but here's the context. 5 years ago, that same rate was just 1.512%. It has more than doubled. And even though the Federal Reserve cut rates 3 times in the second half of 2025, the total interest expense keeps climbing. Not because rates are going up right now, but because the base of debt underneath those rates is so enormous that even a stable rate applied to a growing principal produces a bigger bill every year. In fiscal year 2025, the United States government paid nearly $970 billion in interest on its national debt. Almost $1 trillion just in interest. It is now the third largest line item in the entire federal budget. Bigger than Medicaid, bigger than the military. We spend more servicing the cost of past borrowing than we spend on the defense of the country. And the projections are not getting better. The CBO forecasts that net interest as a share of all federal outlays will be 13.85% in fiscal year 2026. It rises to 14.11% in 2027 and 14.52% in 2028. And that line keeps going up through 2036, nearly 15 cents of every federal dollar just to pay interest. What does that mean in practice? It means that as interest payments consume more of the budget, everything else gets squeezed. The money available for infrastructure, for healthcare, for education, for defense, all of it faces increasing pressure. And the only ways out are politically brutal: raise taxes, cut spending, or borrow more. And historically, the answer has consistently been borrow more, which only makes the problem larger in the next cycle. The Congressional Budget Office also projects that, under current law, federal debt held by the public will rise from 101% of GDP today to 120% of GDP by 2036. We will have debt larger than the entire economic output of the country by 1/5. That is territory not seen since World War II. And unlike the post-W2 era, there is no economic boom about to bail us out. There is just more debt, more interest, and more printing. Net interest on the national debt has nearly tripled in the last 5 years. If that were happening to your household, you would be in serious financial trouble. For the federal government, it barely makes the news. Now I want to connect this debt crisis to 2 things that are unfolding in real time, and that most Americans are either unaware of or not taking seriously enough. The first is Social Security. Social Security's retirement trust fund, the Old Age and Survivors Insurance Fund, is now projected to be depleted by 2032. That is 6 years from today. The combined trust funds, including disability insurance, run dry by 2034. And these numbers are not stable. They have actually been revised to be more pessimistic recently because legislation passed in 2025 changed how Social Security benefits are taxed in ways that drain additional revenue out of the fund and move the insolvency date forward. When the retirement trust fund hits zero, what happens is very specific. The program does not disappear, but it can only pay out what it collects in that year through payroll taxes. And based on current projections, that means an automatic across-the-board benefit cut of 24% for everyone. For a typical couple, that is roughly $508 less per month arriving in their bank account starting in 2032 or shortly after. No vote required. It is baked into existing law. And I want to be blunt about what is not happening. Nobody in Washington is addressing this, not in any meaningful structural way. The discussion does not even really get serious until we are a year or two away from the cliff, at which point the options are fewer and more painful for everyone involved. And the connection to the broader debt crisis is direct. When the Social Security fund needs to be rescued, the pressure to borrow even more will hit at exactly the moment the government's debt burden is already at its worst. Now, the second thing, and this is the one I think is most important for people to understand right now, is the bond market. For decades, U.S. Treasury bonds have been the ultimate safe haven asset. The playbook has been simple, and it has worked. When crisis hits, when stocks sell off, when geopolitical risk spikes, investors rush to U.S. government bonds. Demand goes up, prices go up, yields come down, and the U.S. government gets to borrow more money even more cheaply. It has been the foundation of the post-1980 financial system. Look at what has been happening since the Iran war started on February 28th. Stocks sold off, that was expected, but bonds also sold off. At the same time, prices down, yields up, when they were supposed to go in the opposite direction. That is a profound deviation from 40 years of market behavior, and it is a signal that should not be ignored. Why is it happening? Because bond investors are sophisticated, and they are looking at the same numbers I just walked you through. They are looking at $3,886 trillion in debt, a $1.9 trillion annual deficit, nearly $1 trillion a year in interest payments, and Social Security running toward a cliff. And they are asking, is the United States government a reliable borrower? Is this still the safest place in the world to park money? And the answer, for more and more large institutional investors, is not as obviously as it used to be. Japan holds roughly $1.2 trillion in U.S. Treasury securities, the largest foreign holder of U.S. government debt in the world. But Japan's own domestic bond yields have been rising. When Japanese investors can earn competitive returns at home, the incentive to hold U.S. paper weakens. And when the largest foreign buyer of your debt starts pulling back, you have to offer higher yields to attract new buyers. Higher yields mean higher borrowing costs. Higher borrowing costs mean a bigger deficit. A bigger deficit means more debt. And more debt means higher interest payments. The spiral feeds itself. One major European pension fund recently announced it is selling its U.S. government debt holdings. These are not day traders or speculators. These are institutions with multi-decade time horizons that have held U.S. Treasuries as the bedrock of their safety allocation for generations. When they start walking away, you have to take notice. This process is called de-dollarization. And let me be very precise about what that means, because it gets distorted. It is not a single event. There's no day when a bell rings and the dollar collapses. It is a process, a slow, structural grinding shift in how the world allocates capital. Countries and institutions gradually reduce their dependence on U.S. dollar assets. They diversify into alternatives, and that process has been underway quietly for years. The events of 2026 are accelerating it. So, if people are moving away from U.S. Treasuries, where are they going? The answer that keeps coming up among central banks, sovereign wealth funds, and informed individual investors is gold. And the reason is not complicated. Governments cannot print gold. Central banks cannot create more of it by passing legislation or adjusting a number on a database. It exists in a finite physical supply, and it has preserved purchasing power across every major episode of currency debasement in modern history. When paper money loses credibility, and right now there are real questions emerging about the long-term credibility of the dollar, the case for gold becomes not speculative, but logical. And now, I know what some of you are thinking. If everything I just described is happening, if the debt is exploding and the bonds are selling off and a war is underway, why isn't gold spiking right now? Why isn't it at $3,500 or $4,000 an ounce? And here is the honest, straightforward answer. When a broad financial market sell-off occurs, when stocks go down hard, bonds go down, crypto goes down, institutions and hedge funds managing large portfolios face margin calls. They need to raise cash quickly to cover losses and meet obligations. When forced selling hits, and it always does in a broad market panic, gold goes down with everything else. Not because it lost its value, but because it got caught in the liquidation wave. That is the near-term dynamic you are watching play out right now. But look at the longer chart. Gold's trajectory over the past year, and especially the past 3 years, is still pointed upward. Yes, we are off the highs, but the fundamentals driving gold higher have not changed. If anything, they have gotten stronger. Let me put it this way. To be genuinely bearish on gold over the next 10 years, you would have to believe this time is fundamentally different, that after decades of consistent overspending, borrowing, and money creation, governments and central banks are about to reverse course in a meaningful and lasting way. History says otherwise, and the numbers we just went through give no indication that we are anywhere close to that turning point. So to be clear, I'm not telling anyone what to do with their money. This is not financial advice. What I am doing is giving you the most accurate picture I can of the structural forces at work in the global financial system, so that whatever decisions you make them with your eyes open. And here's the note I want to close on, because I think it is the most important thing I can say. Most Americans have genuinely no idea how any of this works. And I do not say that to be condescending or dismissive. I say it because the financial system is complex, the numbers are enormous, and we have built a media environment that is extraordinarily good at capturing your attention with short-term news and genuinely terrible at explaining the slow, structural forces that actually determine your financial future. The bond market is not glamorous. No one is making viral videos about treasury yields and debt-to-GDP ratios, but the bond market is the actual foundation of the global financial system, not the stock market, not cryptocurrency, the bond market. When it gets shaky, everything built on top of it gets shaky. And right now, for the first time in a generation, the bond market is showing real, meaningful cracks in confidence around U.S. Treasuries as a safe haven asset. That is a big deal, bigger than most people realize. The debt we are carrying is not going to be paid back in any traditional sense. The interest payments are going to consume an ever larger portion of every tax dollar collected. Social Security is heading toward automatic benefit cuts in 6 years, unless Congress acts, and Congress is not acting. And the world is slowly, quietly arriving at the conclusion that the United States is not going to resolve these issues through fiscal discipline alone. These are the dynamics that are going to shape the financial landscape for the next decade. The inflation you feel, the interest rates you pay, the retirement security you're planning for. All of it traces back to the numbers we went through today. That is what Finance Deciphered is here to do. Not to scare you, not to push an agenda, but to make sure you have the full picture. Because the more clearly you understand the landscape, the better the financial decisions you can make for yourself and your family. If this video gave you a clearer understanding of the U.S. debt crisis and what the bond market is telling us right now, please subscribe to Finance Deciphered and hit the notification bell so you do not miss the next one. Because the CPI report comes out this Wednesday, and inflation, debt, and interest rates are going to be right back at the center of the story. Thank you so much for watching. Take care of yourself out there.